Hey everyone, and welcome back to the channel. In today's video, we're going to look at 5 common mistakes that are often made when it comes to velocity banking. These mistakes will range from ones that can be made while implementing velocity banking, but also ones that can occur when just learning about the strategy. Be sure to stay to the end of the video where we share a common mistake that can often occur with velocity banking, but is also very common with everyday financial decisions. So without wasting any more time, let's jump into our first mistake, which is not planning for emergencies. When it comes to velocity banking, the benefits of accelerated debt repayment and saving on interest can seem fantastic, but the reality is emergencies do occur, and not planning for them can be extremely detrimental. With velocity banking, individuals leverage some sort of line of credit, such as a HELOC, to make a lump sum payment onto their debt, such as a mortgage. This is great because it immediately lowers our balance on our debt, such as our mortgage, which results in us paying less interest on that mortgage. But of course, for this to work, we still need additional cash flow to pay back that line of credit, in this case, our HELOC. For many people, they feel comfortable using their additional monthly cash flow to satisfy this loan. But what if all of a sudden there is a change to our monthly income? Maybe you lose your job, have an unexpected child, or some sort of medical emergency. These things happen more often than we expect, and the reality is our loan payments will not stop if these events occur. That is why it's imperative to plan for these events, because if you're unable to pay back our line of credit, we'll end up in a much worse place than when we started, especially if we have a secured loan such as a HELOC. Using a HELOC means that our loan is secured due to the equity in our home. Failing to pay back the loan can mean losing our home. Number 2, focusing on interest rates rather than the type of interest. Probably the most common thing that comes up when individuals start to learn about velocity banking is, why would I ever use higher interest debt to pay off my lower interest debt? And at a first glance, this can seem logical, but it fails to factor in the differences between amortized and simple interest. With simple interest, the interest is calculated only on the original amount borrowed, known as the principal. For each period, the interest remains the same, making it easy to calculate. For example, if you borrow $1,000 at a 5% simple interest rate for 1 year, you would pay $50 in interest. In contrast, amortized interest considers both principal and the accumulated interest. With each payment, a portion goes towards reducing the principal, and the interest is recalculated on the remaining balance. That is why it's important when first learning about velocity banking to not immediately disregard it just because your mortgage or other kind of debt has a lower interest rate than your line of credit. Number 3, thinking there is no psychological risk. Even if someone is to factor in the first 2 mistakes and has an emergency fund and understands differences in types of interest rates, there is still always going to be psychological risk when it comes to velocity banking. As we all know, to implement velocity banking, we need access to additional capital. If this capital is used properly, it can potentially help us pay off our debt faster and save on interest. But this also poses a risk for some people. If this additional cash is used for unplanned purchases, it can quickly leave us in a worse place than where we started. As well, when we begin to implement velocity banking, we of course lower the balance on our debt, which in turn gives us access to additional credit. This often leads people to do things such as remortgaging their home or taking an additional vacation and putting it onto their credit card. That is why it's extremely important when looking at velocity banking to not only consider how it could mathematically work, but also the psychological impact. If you're someone who has a history of impulse spending or spending beyond your means, it's extremely important to factor this in as a risk before committing to something like velocity banking. Number 4, failing to factor in fluctuating interest rates. As we have seen over the past couple of years, interest rates can quickly go up due to factors out of our control. And if your line of credit has a variable interest rate, your payments could go up unexpectedly, making it challenging to manage your finances. This can strain your budget and potentially slow down the progress of your velocity banking strategy, or even make your situation worse. That is why it's important to be aware of the potential for interest rate fluctuations and to consider how these changes could impact your ability to make timely payments and stay on track with your debt repayment strategy. Always ask yourself, if changes occurred that were out of my control, such as rising interest rates, would I still be able to successfully implement velocity banking? Our final mistake is not only unique to velocity banking, but everyday finances in general, and that is failing to evaluate alternatives. When it comes to velocity banking, it is not a one-size-fits-all strategy. What might work for one individual just might not make sense for someone else. For example, maybe you already have a very low interest rate on your mortgage. Well, in this case, it might make more sense to put your additional cash flow into other investment streams, such as an index fund, rather than using it to accelerate your mortgage repayment. And again, the same goes for other financial decisions. Always evaluate your own current situation and look at alternatives to make sure that you're making the best financial decision that is tailored to your own unique situation. Thank you for watching, and if you found this content to be helpful, please give the video a thumbs up and consider subscribing to the channel down below.